Well, looking at values and how they performed over March and over the longer term as well, we saw dwelling values rise by 1.4% over the month itself, largely driven by a very strong capital gain in Sydney. Sydney values are up by 3% over the month. Every other city was relatively flat, in essence. When you look at the longer term trend over the past 12 months, we've seen once again Sydney really driving the housing market here in Australia. So values are up 14% or nearly 14% in Sydney. Melbourne was up by nearly 6%, and then every other capital city is seeing growth of less than 3% over the year. In fact, Perth values are down, Darwin values were down, and Hobart values were down less than 1%. So it's still not a great correction, but down nonetheless. The main factors that are really driving Sydney's housing market are firstly investment. We're seeing investors now, excluding refinance loans, investors are now about 60% of all new mortgage originations in New South Wales. That's a record high, and we've never seen historically owner-occupiers being outweighed by investors. We've seen that now for the past 6 months. So investors absolutely are the driving force of the Sydney market now, followed by upgraders. First home buyers still relatively slim on the ground, particularly from a first home buyer owner occupation standpoint. But anecdotally, we are now starting to see more first home buyers getting into the marketplace as investors rather than as first home buyers traditionally. Well, we saw the Melbourne market peak back in April of last year, and since that time, the annual rate of growth has fallen back to just below 6%. So Melbourne, once again, has been the city where we've seen the most amount of new supply come online. In fact, when we look at the top 20 regions around the country, Melbourne has topped the leagues tables the last 5 years for new housing supply. So a lot of new supply, and that tends to keep some downwards pressure on, or at least a lid on the rate of price growth. But in saying that, population growth is still really strong into Victoria. It hasn't seen the sort of slowdown that the mining states have seen. So even though supply levels are historically very high, we're also seeing demand levels very high as well. When you look at the growth figures, the capital gain figures, it is mostly skewed. The higher growth figures are skewed towards detached housing rather than the multi-unit sector, which is where most of the new supply has come online, is apartments. So we are seeing the rate of growth moderating across the combined capital city index that CoreLogic RV data published. So the index peaked in April of last year with dwelling values rising at about 11.5% per annum. We've seen that rate of growth slip back to about 7.6% over the most recent 12-month period ending March. I think that rate of growth will probably continue to moderate, but we have seen a little bit of a rebound over the first quarter. I think that can be attributed partly to seasonal factors. The March quarter is generally seasonally quite strong, but also, of course, we have seen the February rate cut and potentially another rate cut coming in April and potentially even another one after that. Looking at what's happening with iron ore prices, the RBA may need to stimulate the economy even further. So if we do see interest rates moving even further, then potentially we will see some reinvigoration of the overall growth trend. But if we do see another rate cut, it could have the opposite effect on consumer confidence. Obviously, we're cutting rates for a reason because economic growth isn't quite as strong as what it's been projected to be. So what are some of the key takeouts for property managers in a marketplace where capital gains are so strong? Well, I think firstly and importantly, when we're seeing investors such a big part of the marketplace, every investor is typically a new landlord that requires a property manager. So the property management space should be growing quite substantially based on the fact that investors are now outweighing owner-occupiers nationally, and they're 60% of the Sydney market roughly. So I think for the business, for the industry, it is growing at quite a significant pace now. For landlords and property managers, of course, I think there hasn't been a great deal of focus on rents. We're seeing rents rising at a very slow pace at the moment. The fastest rate of rental growth is in Sydney, and it's 3.3% per annum at the moment. And when values are rising at 14% per annum, you have this overall yield compression. And it's not just Sydney where yields are compressing, it's actually every capital city where rents are growing at a slower rate than what dwelling values are. So I think more focus on ensuring both sides of the investment equation are healthy, and that's both capital gains and a yield, is really important for a rental manager. And even though capital gains are very strong, a lot of landlords and rental managers tend to, I suppose, forget that there should also be some upwards pressure on rents, particularly with vacancy rates remaining relatively low across each of the capitals. Looking at the REIA data, vacancies are typically still below 3% in most capital cities, which implies rents should be more inflationary than what they are. Well, the Reserve Bank is in quite a challenging position here. They have on one side very strong house price growth. Sure, it's all coming from Sydney, but still at a macro level, Sydney is a big influence on the housing market. But on the other side, we still have economic growth which is underperforming. We have weaker labour markets, retail spending is improving, but it's not great. We have households still quite conservative with the household savings ratio still nearly 10%. On top of that, we're seeing falling commodity prices still. So iron ore has hit the front page of the papers once again and projected to fall to record lows or the lowest point since the 90s. So it's quite important for the RBA to stimulate economic growth, and to do that they're going to need to cut rates again.